All right, guys. So welcome to the Foundations of Forex Trading workshop. This is a workshop for beginners where we'll be talking about the basics of what Forex trading is up to a point where you're able to take trades. Okay, so if you're just getting started in this Forex industry, this 2-day webinar is the best thing that will happen to you because we're going to trash out all of the fundamentals you need to have in place in order for it to be very, very profitable. This webinar is powered and organized by TenTrade. I'm speaking to you this evening. My name is Toby Okunuga, and I'll be your anchor for the next 2 days. All right. So it's also going to be an interactive session as much as possible. So as I am showing us this basic concept, if you have questions, note down your questions. There'll be a time for Q&A as well. Likewise, majorly tomorrow, we are going to delve into the practicals. Okay, so ensure that you just don't only participate today, you participate tomorrow as well, because tomorrow is where the major juice lie, right? So today we're going to spend the majority of our time really focusing on theoretical aspects of the financial market. Tomorrow we'll go real deep into practicals, into implementation, what to look out for in the market. To be talking about some structures. So it's going to be an amazing ride in a nutshell. So let's just get started because of time. Okay, so let's start from the very, very basics. Forex. When we talk about Forex, what exactly are we talking about? The first thing I want you to have at the back of your mind is that Forex is an abbreviation of foreign exchange. Okay, it's an abbreviation of foreign exchange, right? And then the other thing that I want you to know is that the Forex, right, is the Forex market is the largest financial market that averages $6 trillion in trading volume daily. That means on a daily basis, average transaction that occur in the financial market, in the Forex market, is averaging $6 trillion US. Okay, so that talks about the currencies that are being bought or sold in a particular given day. All right, so it's a world of opportunities in the Forex market for you and I to be a part of. Okay, and then the Forex market is open 24 hours a day and 5 days a week. So the market is only open from Monday to Friday. The first market is not open on weekends. Okay, and then somebody might have asked me, is there a physical location for it? Because there's a market in front of it, right? So there is no office for Forex trading. Okay, there is no physical location for it. Everything is done online through what we call electronic communication network. Okay, so there's a whole system and structure in place that is very well regulated, whereby the Forex online trading take place. All right. So talking about trading online, what makes it possible for you and I that are retail traders to be able to trade online? Because what we are doing is foreign exchange. If you go see if you see somebody doing your normal exchange business, or like you go to an exchange office and then you want to change your dollar to naira. Now, usually those people hold paper currency. For exchange to take place, there has to be physical, the legal tender, right? But when it comes to Forex trading, we are doing the same thing. We are buying and selling currencies, but everything that we are doing it online. Okay, now that phenomenon is made possible by what we call CFD, which is contract for difference. Okay, so what we do as forex traders is to trade CFDs, contract for difference, right? So this type of financial instrument allows you to benefit from fluctuations in price of stocks, commodities, indices, and more without really purchasing them. So you don't own the asset that you trade. All right. So in other words, you don't need to hold dollar or to hold the euro or pound physically to be able to trade successfully in the foreign exchange market, right? Everything is done via what we call contracts for difference. And another benefit of CFDs is that regardless of the direction of price, either a particular currency is gaining momentum or losing momentum. As a trader trading CFDs, you can make money both ways, all right? So either price is going up like so, okay? You can buy low and then you sell high. Or if price is going down like so, right, you can sell high like so, and then when price is going down, you are making your profit. So you are able to make money regardless of the direction of the market. And then that's the beauty of trading CFDs, right? So once you know exactly when to buy and when to sell, you'll be very, very profitable, right? So we have some sort of edge above normal exchange business. Okay, so the skill set to buy and then the skill set to sell is what we are going to be learning in this 2-day webinar. How do you know when to buy? And then how do you know when to sell? Okay, that's a skill set that will make you money. Okay, but let's go ahead. Now, let's compare the Forex market and the stock market. If you have been around for a while, you'll have heard about the stock market, right? Now, let's do a simple comparison. Now, in the Forex market, what do we do in the Forex market? We trade currencies in the Forex market. In the foreign exchange market, what is traded are currencies. Currencies like the euro, like the US dollar, like the pound sterling, right? While in the stock market, what is traded are company stocks. So what you have on the stock market are company stocks. So the stock market is different from the Forex market, right? So stock markets is where you find stocks like Apple, stocks like Facebook, Tesla, and the likes. And everything as well can be traded via the CFDs that we've talked about. Okay, so you can make money either on the foreign exchange market or on the stock market as well, leveraging on contract for difference. So you're able to make money either price is going up or price is going down. So I'll show you how to do everything, okay, today. And also good 10Trade, which is the broker, okay, sponsoring this event, allow you to trade, to be active in the Forex market, the stock market, even the crypto market as well, because 10Trade is a multi-asset broker, okay? So when you compare take a look at these charts right here. We can see a chart representing the volume of the Forex market and stock market. Now, every country has a stock exchange. Okay, the stock exchange for the US is the New York Stock Exchange. For Asia is Tokyo Stock Exchange. For the UK is London Stock Exchange. Now, when you compare the volume of transactions that happen in the stock market and the foreign exchange markets, it's so huge. Now, the Forex market is averaging $6 trillion, right, on a daily basis, like so, okay? And then the largest stock exchange in the world is the New York Stock Exchange, right? And is averaging about $22 to $25 billion on a daily basis. So when you compare these two, it's like comparing a giant to, a midget. But that does not mean that you cannot still make money in the stock market as well. So you can equally make money trading stocks or trading currencies, all right? So what you choose to trade depends on you as the individual. So 10Trade provides that platform for you to either trade in the financial market or trade in the forex market or trade in the stock market. Okay. So moving forward. So we say that in the forex market, the market is averaging $6 trillion on a daily basis. Now you must not ask yourself, who are the people that are bringing together this $6 trillion every day, right? Where is the money coming from? How does the money move from one place to another? Who's buying and selling in the forex market? Okay, so one thing that will explain that is this concept called the market participants or the market players. These are categories of people that are pulling the funds into the forex market. So we have hedge funds. So hedge funds are financial institutions that manage a portfolio of very high net worth individuals or high net worth corporations. So they take money from wealthy people or wealthy companies in the hopes of helping those people make returns at the end of the year. Okay, so hedge funds, an average hedge fund that is operating has nothing less than $1 billion, okay, under their management, right? And then we have hundreds, if not thousands, of hedge funds out there. Okay, so these people are also competing in the forex market, trading money in order to make profits. We have central banks as well. Every country has some sort of a central bank, okay? And those banks as well, they have to actively compete as well in the forex market so that the local currency in that country will be strong against every other currency, okay? So they're actively investing in the forex market. So when they put money in the forex market or they remove money, it's going to have some sort of effect in price, right? You have commercial banks as well, like your, Wells Fargo, like HSBC Bank, like Chase Bank, or Bank of America. Okay, so those banks as well, because they have they have huge volume. Okay, they can also influence price. They can influence market direction. Okay, in a certain way. And then number 4 on the list, we have forex brokers. Forex brokers are financial institutions that bridge the gap between the forex market and individuals that want to trade in the forex market, like you and I. So if you as an individual wants to trade in the forex market, you cannot, who do you call? You cannot trade directly into the forex market, okay, because you don't really have the huge funds to place a direct trade in the forex market over the counter. Okay, so the forex broker, okay, who has all of the contact, the connect, and the infrastructure, helps us, gives us leverage in order to be able to trade profitably in the foreign exchange market. And then you have companies as well, small companies, private equity firms as well that also manage funds for people. They are also actively trading in the forex market to make profits. And then last on the list is individuals like you and I. Okay, individuals, we call ourselves retail traders. Okay, so everybody here is what make up the forex market, and everybody on this list is in the market to make money. So it's a highly competitive environment. Okay, so hedge funds make money and then they lose money. If a hedge fund should make money, for example, they are going to make money from every other person in these market participants. If you as an individual, you are trading your capital, for example, and then you make a profit, that profit that you've made is because somebody else lost a particular trade. So it's a highly competitive environment high risk. That is why you need to be sure about what you are doing. You need the right skill sets to be very, very profitable. Okay. And an average hedge fund, an average bank or broker, they have teams of analysts, okay, that will help them make adequate trade decisions. You are, as an individual, are just one man, okay, competing against a team of analysts. So in order to be able to beat or follow these big financial institutions, you need to have the right skill set. And then that is what TenTrade is also committed to helping you achieve, to not only give you the platform to trade, but to educate you on how to be a successful and profitable trader. Okay. So forex brokers, this life of broker. So like I said, brokers serve as the middle man, okay? Some sort. So this is you as a trader. You want to place a trade in the market. In order for you to place in the market, you need to go through the forex broker. So the forex broker takes your buy trade, for example. So let's say you want to buy a particular currency. So the trader, okay, in real time, the trader takes your trade, okay, quote it up, with infrastructure that they have, with all the liquidity providers, okay, so they place your trade in the foreign exchange market. And then when you make a profit as well, everything goes to the broker and then first, and then goes to you. So all of this has an infrastructure in place that make it very, very seamless. Okay, so brokers are actually doing a lot, and then they're helping you and I create an income stream that is very, 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 very profitable. Okay, and TenTrade is an amazing broker that does this easily, right? So our recommended forex broker is TenTrade. Of course, as an individual, if you want to trade in the foreign exchange market, you need to trade via a forex broker. Okay. Again, if you don't have an account with TenTrade, you want to go to this link to create an account. It's free to create an account. And also, TenTrade is running a New Year promo, such that when you place on your first deposit, TenTrade will give you 50% bonus. So let's say you make a deposit of $1,000, you are going to receive an extra $500, okay, in your trading, in your MT5 account that you can trade, right? And then you don't have any issues with it. You can withdraw your capital at any point in time, at any time, okay? So I'm not sure how long that offer is going to last. So if you're an existing trader or you're a new trader, you want to take advantage of this as much as possible to increase your equity in the market. All right. So we'll see, find time today or tomorrow to really delve into the TenTrade platform, and then you say exactly how it is. Okay. But let me just digress a bit because we might not have time. So this is how the TenTrade platform looks like. So when you go to ten.trade, you'll be brought to this platform. And then all you have to do, if you don't have an account, all you have to do is to click on register right here. So when you click on register, you'll be taken to a page whereby you just fill a short form, and then you are good to go. Okay, you are good to go. Immediately you receive an email from TenTrade sending you all of your login details, and then you have access to your dashboard. All right, so we'll go over that much later. Okay, so let's move forward because of time. Okay, so what do we trade in the forex market? What is traded in the forex market? What we trade, like we stated from the beginning, are currencies. Currencies are traded in the market. Right now, we have pretty much about 100 or more currencies in the world, if I'm not mistaken. And if those currencies, if the countries that own those currencies are interacting with other countries doing trade deals and the likes, they will be on the Forex market. Okay, so what you can trade as a Forex trader are currencies, but it's best as a beginner to focus on the major currencies. The major currencies that will give you better opportunities, consistent opportunities in the market, right? So as a beginner, the 8 major currencies that you want to focus on is this on the screen. You have the euro, EUR is the euro, right? GBP is the Great Britain pound sterling. AUD is the Australian dollar. NZD is the New Zealand dollar. USD is the US dollar. CAD is the Canadian dollar. CHF is Swiss franc. And JPY is the Japanese yen. Okay, like I said, we have over 100 currencies in the world, but you don't want to be trading 100 currencies. It might be too much, right, for you. So you're going to focus on trading these eight major currencies, more than enough for your entire trading career to trade. You cannot, I guarantee you, you cannot exhaust these 8 major currencies. All right. So let's talk about currency pairs. Remember, Forex is a short form of what? Foreign exchange. So what it means is that there's an exchange involved in what we are doing. And then when we talk about exchange, that means there are 2 things involved, right? So we are exchanging money from one currency to another. And then the goal is to make money from the volatility in the exchange rate. All right. So what we trade in the Forex market as a trader, we trade currency pairs, right? We do not trade a single currency in isolation. We have to trade currency pairs because that is what will give us the volatility, the fluctuations that we need in order to make money based off of the rising and falling of the currencies, right? So the most popular currency pair is the Euro USD, okay? So which is the Euro against the USD. So before we talk about that, now let's just quickly talk about the anatomy of currency pair. So when we say currency pair, it contains 2 currencies. Okay, so there's the first one and then the second one. The first currency is called the base currency. It's called the base currency. And then the second currency is called the quote currency. Okay, so my simple analogy to explain this is, so let's say you're traveling out next week. You're in Nigeria right now, you're going to the US, right? In the US, you cannot spend Naira in the US. You can only spend the US dollar. So you get to MMA airport and you go to a bureau de change inside the airport. You go there with your Naira and then you're asking for dollar. What you have in your hand, which is in Naira, is your base currency. What you want to exchange into is the quote currency. So in order for you to exchange your base to quotes, you'll be given an exchange rate, like so, right? So every currency pair has its own unique and different exchange rate. So currency pairs has its own different exchange rates. And again, how you make money with a currency pair is based off of the fluctuations that happen within the exchange rates. Okay, you want to buy low and then sell high. So let me give you a practical example what we are used to. Sometime in 2015, I think $1 was, I'm not sure now, $1 was, let's say 300 Naira. Let us give the figure. $1 was 300 Naira. That was the exchange rate at the time, right? Now, if you had bought a junk, let's say a lot of dollar at that point in time, and then you kept it, okay, so you bought at 300 Naira. Now, $1 is 750 naira. Okay, so you bought at a very, very low price, and then you waited, and now price is at 750. That markup is your profit. So right now, on each dollar that you bought, you've made a profit of 450 naira. Okay, but in trading the forex market, you don't have to wait for years in order to make money based off of volatility. Because of what we talked about in the beginning, the contrast for difference, you can make money in seconds, in minutes, in hours, depending on the time frame that you are trading on. Okay, so that's why I said that if you are trading the 8 currencies, you cannot exhaust the trading opportunities, okay, that those currencies are going to provide for you. Okay, but just have it at the back of my mind that how we make money as forex traders is based off of the volatility that happens, okay, in these currency pairs, because a currency pair is constantly gaining strength or losing strength, and that is why there is volatility there, okay, based off of the strength of the economy of that currency at that particular time, right? So let's move forward, and then we'll start talking about practicals shortly. So how do you make money? What do you do as a forex trader? The only thing that you're going to be doing as a trader to make money is buying and selling, like we said. When you go to the farmers market, so your market where you go and buy your chicken, your tomatoes, and things like that for food, you see somebody selling chicken. Now, that lady selling chicken is also a trader. She's also into buying and selling. How she makes money is she buys that chicken from a dealer at a very, very low price. Maybe she buys in bulk, she buys wholesale, and then she's going to make a profit by selling to you at a higher price. Okay, we are not different from all those traders. Okay, we are also a trader, but now we are forex traders. Our own commodity now are currencies. So what we are trading are currencies. What other people are doing in the market, that person, our own commodity is a chicken, but our own commodity, we deal with currencies, and then we trade these online. So you'll be involved with buying and selling. So you'll be buying at a low price, and then you'll be selling at a high price. It's the same thing, okay? So the skill set that you need to have as a forex trader is knowing when and where to buy at a low price and where to sell at a high price. That is the summary of a forex trader, okay? Because if you buy at a high price, there's a possibility that the price might drop. So if price drops, you make a loss, right? If you sell at a low price, you make a loss. So the skill set is knowing when to buy at a low price, and then you wait for it to increase, and then you sell it off, knowing when to sell at a high price. Okay, so we'll talk about all of that. It's a skill set that you can learn, even though as a beginner, it might sound or look abstract at first, but every new thing that you learn in life usually for the first time looks abstract, but with time, as you devoted time to it, you know, your resources, you really got to understood it. Some of us that were in science class, you know, we had to deal with chemistry and physics. We hated it the first time, but eventually we passed it. For people in art class, some really hated accounting or government, but eventually you got used to it, and then you passed your WAEC, you passed it in your undergrad, and even some did masters, right? So likewise, forex trading is a skill set that you can learn. Even though you have been hearing that people are losing money with forex trading, that doesn't have to be your own case, right? You can learn it and make money from it. There are people that this is their only source of income, and then they are making a killing from it. So if they can make money with forex trading, you can also make money in forex trading. So that means they know something that you do not know, right? So it's all about the skill set. And then 10 Trade is devoted to transferring this knowledge to you, how to trade and be profitable consistently on the long run. Okay, so let's move forward. So let's talk about the concept of a PIP. So we are gradually approaching the practical aspect of forex. Let's start by talking about the most basic concept when it comes to trading, is what we call a PIP, right? So what is a PIP? A PIP is a unit of measurement that is used to show changes in the rate of a pair. It tells us how far price has moved within a particular period of time. So let me give you a practical example. So let's say on Sunday or on Friday, you go to your church or you go to your mosque. And on your way back from the church or mosque, you are going back home. You have to take a ride home or you take a stroll home. So that movement from your church to your apartment is a distance, right? So that distance is measured in meters, right? Meters is the smallest unit of distance, right? It's the smallest metric to measure distance. So you have moved from one point to another point, and that movement is measured in meters. Likewise, remember that when it comes to currency pairs, exchange rate is usually not static, it's dynamic. Every day, every second rather, okay, there's fluctuations in price of currency pairs, okay? So how do we measure that volatility? How do we measure that fluctuations? We do that with the smallest metric called a PIP. So that's why a PIP is a unit of measurement used to show changes in the exchange rates of a pair. It tells you how far price has moved within a particular period of time. So let's take an example here by looking at Euro USD. So this is Euro USD, right? And then we're given this exchange rate. So price moved from this exchange rate to this exchange rate. So we can see a difference here, 1.1005 to 1.1006. So maybe this happened within 1 minute, okay? So as a forex trader, looking at this data, how do you measure this volatility here, this movement? We measure it in PIP. So we need to be able to calculate, to know how to calculate PIPs, how to measure PIP in the foreign exchange market. Okay, so that's the most basic thing that everybody should know. Okay, so basically, there are two ways to calculate PIPs. It's either you do it with a tool that you will have access to on the trading platform. So we'll talk about trading platforms shortly. Okay, so there's a tool on a trading platform that will easily help you measure PIPs easily. So you won't need to do any calculation, right? But the mark of a true trader is, you are reliant on yourself. You don't really need a tool to do anything, right? So it's good to also know how to calculate it by yourself so that in case you don't have access to that tool, by just looking at a chart, you can have an idea as to how far price has moved. So there's this is like an automatic way to do it, and then there's a way to calculate it manually, okay, by your normal math calculation. And guys, it's very, very simple to do. So let me show you the easiest way that I learned how to calculate PIPs, or how to calculate exchange, the difference in price. So all what you want to do is very, very simple. You want to simply start by subtracting this, the origin exchange rate to the destination, right? So simple mathematical subtraction calculation. So what do? We say 1.1006 minus 1.1005. So when you do that calculation, you will have a value of 0.0001. Okay, easy. Anybody that's gone to primary school can do this. So this is step one. It's a two-step process. So step one is to subtract, that's all. And then step two is to move the decimal, this decimal, okay, for every currency pair aside from JPY. Okay, I beg your pardon. Let me quickly, I omitted a particular slide. Let me quickly explain that to you, and then we'll come back to this slide. So let me share a whiteboard and show you something. Now, there's a concept I want to show you. When we talk about currency pairs, remember that I told you that what we trade are currency pairs. So we have pairs like, you know, the USD, you have the euro, we have the Canadian dollars. What else we have? We have GBP. What else? We have JPY, AUD, and NZD. 8 major pairs. 1, 2, 3, 4, 5, 6, 7. There's the last one. There's the last one. Can someone help me? What's the last currency pair? USD, Euro, GBP, Pound, NZD, CHF. So that's a Swiss franc. Okay. Now, these are the 8 major currencies. Now, remember that we said we trade currency pairs. So when you pair each of this currency against another, you arrive at a pair. So if you pair the US dollar against each one, so when you pair the US dollar against the euro, you'd have Euro USD. Against CAD, you have Euro CAD, right? Euro CAD. Against GBP, you have GBP USD, right? Against JPY, you have USD JPY. The USD against AUD, you have AUD USD. The USD against NZD, you have NZD USD. And then against CHF, you have USD CHF. Okay, so now when you pair each of these currencies together against another, once you do the combination, we arrive at 28 pairs that you can trade. Okay, so these pairs are more than enough for you to trade for your entire trading career. So you have 28 pairs that you can trade. I don't even trade up to 10. I trade about 5 to 6 currency pairs, right? And some people only trade one pair. There are people that they only trade Euro USD. There are some that only trade GBP USD. Some only trade. So based on what you feel, what you like, you trade what you like. Okay, so I had to say that because of it will help me explain these concepts clearly about PIP calculation, right? So when we did this calculation, we arrived at 0.0001. So this is step one, to subtract. Step two is to move this decimal. So I was saying for every pair, for every currency pair that does not have JPY in it, for every currency pair aside from JPY pairs, once you do your calculation, you want to move the decimal, this decimal, 4 places forward, 4 places forward. Okay, and then for JPY pairs, you want to move the decimal 2 places forward. Okay, so for this particular example now, we've done our subtraction. Step 1, subtract. Step 2 is to use this method, right? You move this decimal 4 places forward. So that is 1, 2, 3, 4. So this decimal will now be in front. So that is 1.0. Okay, so that's how we're able to arrive at 1 pip. So this is how to calculate it manually, right? So when we get to trading platforms, I'll also show you the tool that we use to calculate pips easily and how to apply everything, right? So this second example, we have a currency pair called USD-JPY, and then we are told that price moved from 104.20 to 104.21. What is step 1? Step 1 is to subtract. So subtract this from this. That will give you 0.01. That's step 1. Now, step 2 will be to move the decimal, this decimal, you move it 2 places forward. Okay, so in this case, 1, 2. So that is 1.0. So that's how we're able to arrive at 1 pip. Okay, so that is the simplest way that you can calculate pip. That is how I learned it easily, and I feel that it will be easy for anybody to learn this way as well. Okay, so these are the 2. If you are sticking with the 8 major currencies, which will give you 28 currency pairs, these are the 2 ways that you need to calculate pips manually. Okay, so you won't need to think about any other way to do it manually. All right, so let's move forward. Now, very soon we'll start talking about application of this pip, because why is pip important? You get to know it in the next few slides. So let's talk about spreads. Now, a spread is a difference between the bid and ask price. Remember that I said that for individuals like you and I that wants to trade in the Forex market, we need to trade through the broker. So the broker, when you place a buy trade, the broker are the ones, for you as a retail trader, they're the ones that are in control of the price at which you are going to enter the market, because there's a whole lot of infrastructure that a broker has to go through to give you a quote. Okay, so spread is how majority, or if not all, is how brokers make money. They make money based off of spread. Okay, in simple terms, spread is the difference between the bid and the ask price. Okay, so if you want to sell a particular currency pair, right, so the broker will put their markup on the quote, right? So they'll take you in at a particular quote. If you want to buy, they'll take you in at a particular quote, all right? And that quote is based off of the spread. So this spread will be the difference between the bid. So this is the bid price, and then this is the ask price. All right. So this is the broker's commission, okay, to put you into a trade, because you must also know that the brokers are giving you leverage. Ideally, I think the minimum amount that you should have if you want to trade directly in the foreign market is about $100,000 or $1 million. Okay, but now somebody that has $10 or $100 can now trade in the market, because the broker is going to give you leverage. The broker is giving you access to liquidity. So they match. So if you're using a leverage of 1 to 100, for example, what this means is that if you use this leverage, it means that the broker is going to match every dollar that you have. The broker will match it with $100. So if you have, let's say, $100 and then you are trading with $100. That means in actual fact, you are trading with $10,000. Okay, so it's a bit complex what the broker does in order for you to be able to trade successfully in the market. So that is why they're charging you a commission, because they are also dealing with liquidity providers. All right, so don't let it dwell too much on spread, but it's very important that you understand what a spread is. Before you enter every trade, you'll be charged a spread. Okay, and thankfully, Centrade has one of the best spreads out there, little commissions, and then you are into the trade, right? So let's move forward per time. So let's talk about lot sizes real quick. So it gets interesting once you understand what a lot size is. So a lot is the number of units of base currency that you can buy or sell at a time. So in order to really explain this concept to you, I would like you to think about, for people that, we just finished playing the World Cup in Qatar, and, a lot of people, the finals, for example, Argentina against France, a lot of people wanted to put their money where their mouth is. So they leveraged on, sports betting platforms. For example, a popular one in Nigeria is your Sportybet, or let's say 1xBet. Okay, very, very popular. On 1xBet, if you plan to, if you want France to win, for example, they are going to ask you for your stake. How much are you putting for this trade, for this particular, for that particular prediction? All right, so what is your stake? And then your stake is all determine how much you will lose or make, because they'll also give you the odds. All right, so likewise, when you're trading in the foreign exchange market, think about lot size as your stake. And that stake is all determine how much you make or lose in the market. Because before you place a buy or a sell order, right, the broker like Centrade is going to ask you for the lot size. What is the lot size? How much are you risking from your capital? Okay, so lot size is what we use to determine that, right? So let us quickly explain this real quick. So we have 4 categories of lot size. The least being the micro lot, the nano lot. We have the nano lot, we have the micro lot, we have the mini lots, and then we have the standard lots. Okay, but right now, let us forget about nano lots, because most brokers would start with you from micro lots. So let's remove nano lots. Okay, so from micro lots to standard lots, if you're trading currencies, is what you'll be dealing with. So also, please skip this unit. I don't want to go into math, all right? But skip this unit. Focus on volume and dollar per pip. So when we go to talk about micro lots, let me go to the whiteboard and explain this properly. So let's clear this up. So we have 3 major categories at the trader trading currencies. You have the micro lot, we have the mini lot, and then we have the standard lot. Okay, for a micro lot, the lot size starts from 0.01 to 0.09. For a mini lot, the lot size starts from 0.10 to 0.99, right? For a standard lot, the lot size starts from 1 to, let's say, 1,000 or 500, based on, that depends from broker to broker. So let's just say, to be safe, let's say 1 to 500. So If you use a lot size between 0.01 to 0.09, that means you are trading with a micro lot. If you use a lot size between 0.1 to 0.99, that means you are trading with a mini lot. If you use a lot size between from 1 to, let's say, 500, that means you are trading standard lots. Okay, so what exactly does this mean? How does this translate into money? Okay, so what does it mean if you use a micro or mini or standard? Okay, so let's do an example for a micro lot, for example. So a micro lot. So let's say we use a micro lot, the lowest micro lot, let's start with that of 0.01. So you are entering a trade with 0.01. What does this mean? How does it translate into monetary value? All right. The easiest way to do that calculation is to simply multiply it by 10. So 0.01 times 10. Okay, that will give you the monetary value. So when you multiply 0.01 times 10, that is 10 cents. That is 0.10. Okay, so that will give us a dollar value, 10 cents per pip. So what it means is that if you are trading with a micro lot of 0.01, okay, it means that every pip, every movement in the smallest movement in the market in that currency pair is worth 10 cents to you. All right. So if you take a buy trade, for example, and then that trade goes your way, you are 10 pips in profit. So you take a very, very good buy on Euro USD, and then it is going your direction. You are 10 pips in profit. If you are 10 pips in profit, and then you are trading, you enter that trade with a micro lot of 0.01. Okay, 10 pips at 0.01. What does this mean for you? It means that that is 10 pips, okay, times, what does 0.01 mean? It means 10 cents per pip. That means every pip is worth 10 cents. So if you're in profit 10 pips, that will be 10 times the pip. Okay, the value of the pip, that's 0.10. So that will give you, so on that trade, you'll be in profit of $1. Okay, so that is your stake in the market. So if this move also goes against you, you will also lose $1. Okay, so let's make it more interesting. So let's say you use a micro lot of, let's say 0.08. All right. And then what does 0.08 mean? It means 0.08 times 10. That is 80 cents per pip. So every pip is worth 80 cents to you. Right? So if you take a trade and then you make it, let's say you make 20 pips profit, which is doable. You make a trade and then you are in profit of 20 pips. At 0.08, what does this mean? This means 20 pips that you make, 20 pips. What is the value of the pip? 80 cents. 20 times 0.8, that will give you, how much is that? That should give you $16. So you are in $16 profit. If price goes against you 20 pips, you'll also be in negative 16 pips. Negative 16 pips. All right. Good. So that's how to calculate pips as it relates to lot sizes. So let's do another example for a mini lot. So this is a mini. A mini lot is between 0.1 to 0.99. So use a mini lot size of the lowest one, let's say mini you use a mini lot of 0.10. Now, what is the monetary value of using 0.10 lot? Simply, what you do is multiply it by 10, 0.10 times 10, right? If you do that, you arrive at $1 per pip. What it means, if you're using a mini lot of 0.1, what it means is that 1 pip is worth $1 to you. Okay, so if you take entry on a trade and then what do? You are in 10 pips profit. 10 pips profit. What does it mean? It means you're in profit of how much? 10 times the value of the pip. So 10 profit at, right, 0.10. Okay, so that is 10, this 10 pips. So what's the value of this pip at this? So that is $1 per pip. So that is 10 times 1. That will give you $10. So for this simple 10 pip move, you've made a profit of $10. Okay. On the flip side, if it's a wrong trade that you took and then price goes against you by 10 pips, you would also be in a negative $10. It's as simple as that. So let's say use a higher mini lot of let's say 0.5. Let's say 0.55, for example. It's still under 0.99. So what this means is that it means the value per pip, 0.55 times 10, that is $5.5 per pip, right? If you take a trade and then you have 15 pips in profit at 0.55, that is 15 times the value per pip of the lot that you are using. That's times 5.5. So that's 15 times 5.5. If you do that, what do we get? We should get maybe about 100. I'm not sure. What is 15 times 5.5? Can someone give me the value in the chat box? Mr. Wisdom, El-Rufai Akubu, Emmanuel, Sonny Patrick. What is 15 times 5.5? Okay, so let's bring out our calculator, or if you can do it offhand, type it in the chat box. So let me get a response and then we'll move forward. 15 times 5.5. Okay, I'm expecting our feedback, guys. Good, thank you so much. So that is 82.5. So you have 82.5. Awesome. Okay, it's as simple as that. If you make a profit, you make this. If you make a loss, you make this. Now, there's a caveat to this. How do you know the lot size that you are supposed to use? By tomorrow, we will talk about that, because the lot size that you should use should largely depend on, number one, your capital, your account size, and then your trading goals. Either you want to be conservative or you want to be aggressive. So tomorrow, we'll talk a lot about risk management. And part of risk management is figuring out the right lot that you should use on every trade that you place. Okay, so that keeps your risk in check. All right, so lastly, let's do an example for a standard. All right, so trading standard lot is where you want to be as a trader. Okay, so a standard lot starts from 1. So this is REM where you start making thousands of dollars per trade. You trade standard lots. So let's say standard lots, you start from 1 to, let's say, 500, right? So let's say you're trading a standard lot. The lowest standard lot is 1.0. What does this mean in monetary terms? What's the implication of using 1.0 standard lot? So multiply by 10, right? So that is 1 times 10. So that will give you 10, right? That is $10 per pip. That means every pip is worth $10 to you. Okay, that's the implication of using a standard lot. So let's say you take a trade, a little trade, okay? The same 10 pip trade. Okay, you are 10 pips in profit at 1.0 lot. What does this mean? That is 10 times the value of the lot, which is $10. So that is 10 times 10. Okay, that will give you $100. Okay, so we can take the same trade, start from the same entry, and exit at the same price. If you are using a micro lot and then I'm using a standard lot, I will make much more than you. But we took the same trade, but our lot size is different. So I'll make more, okay, you make less, or vice versa. All right, so when you combine pips and lot size, it helps you to know how much you make or lose in the market. So lot size and pip, they go hand in hand. Okay, so when you are profitable most of the time, this will be in your favor. So that's why the major skill set that you need to learn is the skill set of knowing the right time to buy and then the right time to sell. Okay, give me some feedback in the chat box, guys. Let me know if you understand this concept so far. If you understand, please type a yes or Y in the chat box. Type a yes in the chat box. Let me get some feedback from everybody, and then we'll move forward. Let me know if this concept of pips, lot size is clear so far. I know it's a bit of math, but this is not what you need to actually cram when you start trading, but so that you can properly interpret the values that you'll be getting or how much that you'll be making, is important that you know how the profits or loss come about. All right, thank you so much, Mr. Patrick. Okay, good. So let's move forward. So the next concept that we'll talk about is a concept of, let's go back to the slides. So we'll talk about Forex trading sessions in a nutshell. So when you hear about Forex trading sessions, what exactly are we talking about? So remember that we said the Forex market is open Mondays to Friday and 24 hours a day, Mondays through Friday. So, and within this period, within the 24 hours, some currencies will be active, some currencies will not be active. For example, in Nigeria, business opens 8 a.m. Nigeria, 8 a.m. Nigeria time. So if you are doing, so majority of business transactions that happens in, let's say, a banking environment, for example, is going to happen within 8 a.m. and 5 p.m. Nigerian time. So you would have little trading activity before 8 a.m. and little after 5 p.m. Okay. So when you understand that, and then we now also infuse every other currencies, every other time zone. So we're able to break it into Forex trading sessions, which highlights when these 8 major currencies are active. So the first, the country that's ahead of everybody is Australia, right? So they're ahead of everybody. So they start the day before everybody else. So, and then what is the currency that is available in Australia? We have the Australian dollar, so AUD. We have AUD. We have NZD. Okay, because these are the currencies in Australia. So the first trading session is called the Sydney session. Okay, because it is a session of the currencies that are in Australia, in Sydney. So we call it the Sydney session. Okay, and then, so this is the conversion in my own time zone. So if you're in Nigeria or anywhere you are in the world, you just simply convert 8 a.m. Sydney time to your time frame. Okay, so most likely if you're in Nigeria, this will be 10 p.m. Okay, 10 p.m. or 11 p.m. Nigerian time. All right, so Tokyo session is the next trading session. And in Tokyo, we have the currency pair, the Japanese yen. Okay, so this is when activity starts majorly in Japan, Tokyo, because that's when they start business operations. Okay, in Nigerian time, this should be around 1 a.m. Nigerian time. London session, this is when business starts in the UK. You have the GBP, you have the CHF, which is a Swiss franc, and then we have the euro. Right, so we have three major currencies that are active in the London session. So that means there will usually be heavy trading activity in the London session. And this is, 8 a.m. Nigerian time, thereabouts. All right, so, and then the last trading session is the New York session. So this is when business starts in Northern America. So you have the US dollar, right? And we have the Canadian dollar CAD. So breaking the 8 major currencies into sessions. So we arrive at 4 major sessions. We have the Sydney session, which is the first session, Tokyo second, London third, New York fourth, in that order. Now, when you look at this, you find out that the London session and the New York session is usually the most active session because we have more currency pairs, more currencies that are active in these sessions. And of course, it also helps for people in Nigeria. It makes sense because the timing is just right. So you can look for trading opportunities between the hours of 8 a.m. and maybe 8 p.m. or 10 p.m. thereabout, 8 to 10 p.m. Okay, there are some people that it is not convenient for them to trade this period because, for example, in the US, London time is about 2 a.m. Very few of us in Nigeria can wake up 2 a.m. in the night, 2 a.m. in the morning to start trading. You most likely will be, resting from a long day. All right. So when you trade will depend on, how convenient it is for you to trade or the currency pairs that you like trading. Okay. So if you are trading AUD or NZD, okay, they'll mostly be active as well in the Sydney session more than this. All right. So we'll go deep into sessions as well more later, but this just to show you briefly how we arrive at Forex trading sessions. All right. So there are also other trading sessions, but because we are only considering the 8 major currencies, so that's why we only have four sessions. Okay, Nigeria also has its own session. Assuming Nigeria is a major currency, right? So Nigeria, the naira would also be somewhere here, but the naira is not a major currency. Okay, good. So let's move forward with the time. Now let's talk about candlesticks anatomy real quick. So let me show you something real quick. So this is a trading platform called the MetaTrader 5 platform. It's called MetaTrader. So I'm gonna say, so a trading platform is a platform that gives us a visual representation of fluctuations in price. And that fluctuations is measured. We are using candlestick to depict them. So over here, you can see a red candle and you can see a green candle. These red and green things, they are called candlesticks. So this is what you'll be doing as a forex trader, trying to understand what this candlestick mean, what this pattern mean. This is what you'll be looking at to determine when to buy and when to sell. It's quite boring and very, very abstract, especially when you are just beginning. All right, but this is bread and butter, ladies and gentlemen. Okay, once you start understanding what this can do, it's very, very beautiful. Okay, so this is what you'll be staring at as a forex trader. This is your market. Just like the chicken, the woman that sells chicken, okay, interacts with customers. Okay, this is your own interaction. You will always be on the chart trying to spot profitable setups. Okay, it's as simple as that. So let's go back into the anatomy and then we'll explain what each of these, what the candle mean. All right, so over here we can see two candles, bullish candle and bearish candle. All right, because it is either price is going up or price is going down. So when price is going up in a particular time frame, bullish candle is what we use to represent increase in price. So when you see a bullish candle, okay, that means the exchange rate has increased. When you see a bearish candle, that means there is a deduction in exchange rate. Okay, and you might not always see it in these colors. All right, because on the trading platform, you can decide to change the color to whatever you want to change it to, right? There are some people that for bullish, they use blue, and then for bearish, they use white or black. So it depends on the colors that you like, but just understand the concept. We have a bullish candle, and then we have bearish candle. So when you see a bullish candle, what does all of this mean? What is the anatomy? So let's quickly dive deep into it real quick. Now, the good thing about the trading platform like MetaTrader 5, so let me go back to that real quick and show you, is that we can know exactly what is going on by different time frames. So if I want to know how price is moving every second or every minute or every hour or every 5 minutes, I can easily do that with the trading platform like MT5, right? So over here we have different, don't worry, by tomorrow we'll go deep into platform, but let me just give you something peripheral today. Tomorrow is majorly our practical day. So on MT5 we have trading platforms. We have I beg your pardon, we have time frames. So time frames help you to spool prices into different. So let's say I want to check out what price is doing on the 5 minutes chart. That means if I click on the 5 minutes chart now, so it has given me data. What it means that on the 5 minutes chart, every candle here represents 5 minutes. It means that it took 5 minutes for this red candle to form. It took 5 minutes for each of these candlesticks to form. So I know exactly what price is doing every 5 minutes. If I want to know what price is doing every day, so the daily charts will give you a visual representation of price movement every day. So it took 1 day for each of these candlesticks to form. You can also do it as high as monthly. So this is a monthly chart. It means that every candle that you are seeing here, it took 1 month for this candlestick to form. So you can be very, very flexible with how you view the market or the time frame that you want to use to analyze the market. Okay, so let's go back into candlesticks anatomy real quick. So now that we have that foundation set, now let's talk about the anatomy of bullish candle. When you see a bullish candle, you know, to have an idea about what is going on, what does it mean? So let me bring out this. So a bullish candle, the first part of a bullish candle is the open price. So over here is open price. So it is at this place that price opened on that time frame. So let's say we are using the 5 minutes chart, okay, M5, 5 minutes chart. So that means on the 5 minutes chart, when this candle formed, this price is when the candlestick started forming. That is the open price, okay? And then price opened here, let's say, and then it went up because this is bullish, right? Bullish means that that price gained value in that particular time frame. So price went up like so. Over here is the close price. So this is a price in which price closed, okay, on that particular time frame. Okay, so it took 5 minutes for price to open here and then close here. So after price has closed, another candlestick is going to start, coming up based on where price opened on the next 5 minutes. Okay, so that's open and low price. So what is this high price and what is this low price? So when price opened here, so possibly before it started going up, like so, if first of all, when it opened here, it came down a bit, it went down, okay, but it did not stay down, it started going back up. But that movement had to be recorded. So we will say that this is the lowest that price came within that 5 minutes. So it all happened within the time frame. So price opened here, and at a point in time, price went all the way down. It came down, but it did not stay down. It got some momentum, it went up, okay? It went up and then it kept going up, okay? So this is the highest that price came. So price came this high, but it did not stay up, okay? It lost some value, it dropped again, and then it closed here. So that is the story that the candlestick is telling you. We have the open price, the low price, the close price, and then the high price, okay? And then the distance between the open price and the close price, we call this the body of the candle, okay? This is the body of the candle. And then this, oops, let's delete this. And then this line, this single line here, we call this the wick. So this is the body of the candle. And then this is the wick Okay, this is the lower wick and then it's the upper wick. So just call it wick. WICK. On the flip side, what do we have for a bearish candle? Very, very simple. A bearish candle represents weakness. That means the exchange rates or the price dropped within that time frame. So to represent a drop in price, we have the bearish candle, and then this price is when the candlestick open. So this is the open price, okay? And when it's going down, okay, went down, this is the close price. Okay, so it closed here within that 5 minutes. So it took 5 minutes for price to open here and close here. So we also have data about the high price and low price. So at the point in time, price came up here, but it did not stay up, it went down. At the point in time, in that 5 minutes, price came down here. Okay, so that's the lowest that price came, that's the highest that price came, open, close. So this is what the candlestick is saying. Someone is asking, Mr. Sunday, sir, will it be right if one say that the high price of the bullish candle is used to grab liquidity on traders' stop loss? Not in itself, you are correct, but when we talk about liquidity, we have to take other factors into consideration. Okay, but just, you are correct, Mr. Sunday, but we are just isolating what candlesticks mean right now. Okay, so liquidity is much more than weak, right? For liquidity to be grabbed, you need to consider market structure and operations of structure in the market. Okay, so in itself, it is not a liquidity grab or anything in itself. Okay, it's just a representation of how price moved or is moving. I hope that makes sense. Awesome. So let's move further so that we'll be on our way shortly. So good. So we have the next slide. We want to talk about trading platforms. So as a Forex trader, there are two major platforms that you can be using for your analysis. The number one and the most reputable is the MetaTrader 5. Okay, so most brokers will give you access to, will give you a MT5 account. So 10Trade will give you an MT5 account. So on your MT5, you can do analysis on MT5, and then it's also a platform where you place your trades. So you place your buy and sell orders on MT5. Okay, so TradingView is also a platform where you can do your analysis. We also have another platform called CTrader. There are quite a couple of platforms, but my recommended platforms that you can start with are these two platforms, okay, MT5 and TradingView, and then both are free to use. So in our lecture tomorrow night, we are going to deal with practicals regarding how to use MT5 and also TradingView, right? So the first assignment that you want to do, guys, is to you want to download MT5. So you can download MT5 on your laptop or your phone. So for our tomorrow's class, your first assignment, guys, so that by tomorrow you can follow us as we are doing it, please download MT5. Okay, if you are using a PC, do a PC or on your phone. So just go to your Play Store and download it. Right. Unfortunately, I think it's no longer available on Apple Store right now because of some regulations. Okay, but it's available on Android, right? So there's also a web version for it. So you want to go to just go to Google and then search for MetaTrader 5 download. So you go to the website. So they'll take you to the website and then you see the link to download it, right? Or go to your app store. The next assignment that you want to do is, if you don't have an account with TenTrade, you want to open an account with the broker, which is TenTrade. Okay, and I've given the link. Just go to www.ten.trade to open an account with TenTrade. And then the next thing you want to do is to create a demo account on TenTrade, right? So tomorrow we are going to be taking trades together tomorrow. So you'll learn how to buy and sell. So you do it by yourself, and then you see how you are making money or losing money tomorrow. So tomorrow I'll also show you how to log in to your demo account tomorrow. Tomorrow we'll also start talking about market structure, talking about risk management, talking about stop loss, take profit, and all of those terms that you need in order to participate in a trade. Okay, so tomorrow is fully going to be a practical class, and in order for you to engage, please do this. So Mr. Yakubu is asking this question: what is the difference between MT5 and TenTrade? Good question. The difference is that TenTrade is a Forex broker. Okay, so TenTrade is, like we explained, brokers are the middleman. They give you the opportunity to trade directly in the market. All right. So in order to do that, in order to enable you place a trade, all right, TenTrade uses this platform called MetaTrader 5. It's just like saying, if you want to make a post on Facebook, you need an account on Facebook, right? So TenTrade will give you login details to your own MT5 account. So when you log in with that details, you'll be able to place a trade and then also monitor your trade. So TenTrade is a brokerage firm. MT5 is a trading platform. Is that clear, Mr. El-Rufai Yakubu? Let me know if you understand that explanation. All right, so tomorrow, let us come with this. So let me just quickly go to the TenTrade platform and then show you all of this. So this is the TenTrade platform. Understood. Perfect. So when you log in, so excuse me, let me delete this. So when you create your account, you want to log in, right? So let me log in. So you want to go to the website. Also, if you are a new client with TenTrade, immediately you will be given access. You'll be sent an email, and then your email will contain your login details. Okay, so let's say you are now logged into your account. So this is how your dashboard will look like. So to participate in tomorrow's class, as you know, we are doing it, you want to open a demo account. So when you're logged into your account, click on Open Demo Account. So click on Open Demo Account like so. It's very, very simple. You'll be asked to select account type. Okay, so you don't make Open Demo Account. Okay, so good. So type, you select demo MT5. Leverage, select 1 to 100 leverage. Currency, USD, leave it as that. Initial balance, you want to use a demo account balance that is similar to what or close to what you will be funding your live account with. So if you're going to fund your account, let's say $5,000, you can use a demo account of 5K, for example. So use something reasonable, close to what you want to be funding with. And then you click on continue. So, okay, good. So I cannot create another demo account right now because I've created more than 3 demo accounts. But as soon as you create a demo account, you will be given your login details. So let me show you what I'm talking about. So I created this account. Once you do that, you'll be given your login details somewhere over here as well. And then you'll have access to your ID. They'll give you your ID like so. You also get access to your password. So it is this password, this login and password that you input into your MetaTrader 5, and then you'd have access to the platform. So something like this. So this is how your MT5 looks like on PC, right? Okay. Meanwhile, on your phone, so let me show you how your MT5 will look like on your phone. So when you download MT5 on your phone, hold on. Trying to share screen. When you download MT5 on your phone, what do you have? So you have something like this, right? And what do? How do you log in? You want to come to quotes, click on this at the top, these 3 lines at the very top, your top left rather. Once you do that, it will bring out manage account. So click on that and then click on the plus sign, all right? And then on the find broker, search for 10 trade. Once you do that, you see 10 trade there. You click on 10 trade. And then what do? You just put in, so 10 trade will give you your login ID. So you put in your ID and then you put in your password. Once you do that, you click on login and then you are done. It's as simple as that, guys. It's as simple as that. So tomorrow, once you are logged in to your trading account, right, we are going to start talking a lot about how to look at the charts, on your trading platform. We'll look at how to take a trade, how to manage this platform. So tomorrow is a practical class, guys. So ensure that you are around for tomorrow, and then not just around, ensure that you are here with your 10 trade account open so that you can participate in what we are going to be doing. Is that clear, guys? Let me know if you understand this. Any questions so far, guys? Okay, so any questions so far, let me know so that I'll clarify. So we've learned about the basics of trading. We've learned about what a pip is. We've learned about lot size, about candlesticks, about trading sessions. We've learned about trading platforms as well. So what is left for us to do right now is to start implementing everything that we've learned tonight, right? So we've been here for a bit over 90 minutes now. So let's have some time to, refresh. Tomorrow we'll come in fresh and then we'll deal on practicals alone. So tomorrow, again, will be the most explosive session because you're learning a whole lot tomorrow. So don't miss it for anything. Any questions, guys? Any questions? Mr. Wisdom, Mr. David, Yakubu, Emmanuel, Sonny Patrick, any questions before we end tonight's session? Any questions, guys? If you want me to unmute you, so you ask a question, you can signify, and then I'll do that. So you ask a question verbally, if that will help you. Understood. Good. Awesome. So let's meet again tomorrow night. Tomorrow, same time, 6 p.m. Nigerian time. You access this class with the same link. So I'm waiting for you tomorrow. Please ensure that you have your demo accounts, at least a demo account set up. Log into your demo account as well, so that tomorrow you can participate in the class as much as possible. All right. So guys, thanks so much for being a part of this 2-day webinar. It's the start of something amazing in your trading journey. And then I wish us all the very best. So I'll see you tomorrow night. Good night, everybody. Bye-bye.